think we're going to get started here. So given the turnout today, I'm not sure if Wade needs an introduction. I think most people in the room are familiar with his work. But we're going to hear from Dr. Wade Pfau. He is the Director of Financial Planning at McLean and Watermark. So we'd like to thank Mark and his firm for helping us get Wade out here. Most of you are probably familiar with his work in the Journal of Financial Planning. Wade is the professor of retirement income at the American College in Bryn Mawr, and of course the director of research at McLean and Watermark. He received a PhD in economics from Princeton, and he resides in Bryn Mawr, Pennsylvania. But without further ado, here's Wade Pfau.
Thanks. Good morning, everyone. It's a pleasure to be here, and happy St. Paddy's Day. I see a lot of you did a better job than me at wearing green today. But it's good to be here, and it's good to be talking about my favorite topic. And we have 90 minutes, which is more time than I often get, so we can really dig into things a little deeper. Although I could speak about this for 5 hours, so there are still parts that we have to rush through a little bit. But the idea is to really talk about how retirement income planning has developed as a new field in financial planning and how it really is different from traditional wealth management. And then to talk about different best practices for building retirement income plans and for helping clients who, well, as I'll explain why, really are facing a different set of risks when they get to retirement, and really how to manage those risks more effectively and help clients to meet their goals. So we are experiencing, the statistic is true, there are 10,000 baby boomers reaching age 65 every day. And they're entering into this retirement period in a time of uncertainty for the markets. We have our US historical data, and we can see what worked in the past for different types of retirement strategies. But interest rates are at historic lows. Stock market valuations are well above their historical averages. And that's really a kind of uncharted water for suggesting that returns may be lower in the future. And so some of the strategies that have been simulated on the historical data may not always work if there's going to be a low return environment in the world, in the future. And so advisors are facing this challenge of trying to help their clients in this low return world. And as part of this retirement risk is the sequence of returns risk. It's not that the retiree has a 30-year horizon so we can look at 30-year averages for the markets. It's the next 5 or 10 years that are really going to guide whether that retirement is going to be successful or not. And over the short term, we really should be expecting lower returns. And if we're not helping clients effectively, there's the potential to just hurt everyone in terms of media stories about people who've run out of money and went into retirement with $1 million but ended up at zero at some point. That's not going to be good for the industry, or for those people, of course. And so we need to build and implement retirement income solutions. And I'm going to try to just present some of these best practices of how to think about building a retirement income plan. So the presentation slides are available at retirementresearcher.com/best-practices, or if they're otherwise available through the society, that's fine. But if you'd like to get access now, and then you don't have to worry about taking pictures of the screen, but this is where you can get the slides. Okay, so the agenda, talking about how retirement is different, then talking about retirement risks, and then talking about how to build a successful retirement income strategy using different best practices. And one of the things I'll emphasize is there really are two completely different views about building retirement income plans. So trying to just understand how we can integrate some of the better components of each of these two different schools of thought to build an overall retirement plan. And so the starting point for this, and this is especially relevant for the CFA Institute or for people who've studied modern portfolio theory. So here's Harry Markowitz, writing in the early 1990s. He was asked to write an article about modern portfolio theory and individual investors. And what he's saying in this quote is, well, I never really thought about applying modern portfolio theory to individual investors. That was never the intention. Modern portfolio theory is for institutional investors who have two different characteristics. One, they're basically planning to live indefinitely. They don't have any sort of finite time horizon on them. And then two, they don't really have any spending constraint. Their investment assets are not being earmarked specifically to cover some sort of spending goal. So after an evening of reflection, he realized modern portfolio theory really wasn't meant for individual investors. And then within this article, he's talking about game of life simulations, which is really the Monte Carlo simulations that we do today. He was saying individual planning is so difficult. You really have to simulate different strategies, incorporating all the different aspects, taxes and everything that go into that to figure out what is a good investment strategy for a client. And that's the starting point. That's everything like with the CFP board, when they teach retirement planning, it's all about different tax qualified plans and how to save for retirement. When they teach investment theory, it's all based on modern portfolio theory. There's not really much in there about retirement income planning. It's become a new field, and here's really one of the early statements that we should really be thinking about retirement income differently. So what's different about retirement and why the investment strategies need to be thought about in a different light is essentially retirees have less risk capacity, which means they're more vulnerable to a market decline, causing permanent damage to their lifetime standard of living. Pre-retirement, there's market declines, there's market volatility. It's a lot easier pre-retirement to weather that market volatility and not have too much of an impact on your standard of living than it is post-retirement. Some of the reasons for that are people have reduced earnings capacity. It's pre-retirement, you have this lever that you could just work a little longer, or that you could work a little more, do something that just minimize so that your whole financial plan is not destroyed by a market drop. Post-retirement, to the extent that it becomes more difficult to do that, that has to be a consideration. Pre-retirement, often we think about wealth accumulation and wealth management as just trying to grow as big a pot of assets as possible, not really worried about the eventual spending that will come from that pot of assets. Post-retirement, that spending constraint is now visible. People need to be able to take distributions from their assets to fund their retirement income goals. And that has an important impact. Number 3, that actually heightens and amplifies investment volatility. I'll go into more detail. This is the idea of sequence of returns risk. I'll talk about it in more detail in a minute. It does exist pre-retirement, but it gets amplified post-retirement. And it can have big implications on a retirement plan. And it means that saying the client's going to be invested for the next 30 years, and over any kind of 30-year period, there's going to be a decent average stock market return. Well, that's not really the case it's not that the whole 30 years matters equally importantly. The first 10 years will explain about 80% of whether that retirement is going to be able to sustain a high level of spending or a low level of spending. Individuals also have this issue of unknown longevity. We know a lot about the statistics for life expectancy. We know what percent of the population will live to age 70 and to age 80 or to age 90 and so forth. But for any particular individual, they don't have that knowledge. They don't know how long they're going to live. So in an investment portfolio, they have to basically, what we do, we assume they live well beyond life expectancy, whether that be to age 90 or 95 or 100. We try to make sure the plan's going to work that long. And the longer the plan has to work, naturally, the less you can spend to ensure it's going to work long enough. So with this unknown longevity, if you're trying to manage that longevity risk on your own, it means you may lead to lower spending than could have otherwise been possible, because that's the only tool you have to manage that longevity risk. Spending shocks, it's of course difficult to know what your budget's going to be in the future. This becomes a bigger issue in retirement as well, because there's going to be new types of spending shocks that people were not used to. Long-term care, increasing healthcare expenses through the aging process. So just having the plan in place, you need to have some sort of contingencies plan for how to deal with unexpected expenses. Compounding inflation, so this is natural enough for a room of advisors, but for households it's the money illusion that even a low stable inflation rate compounds over time. So historically in the US with 3% average inflation, the purchasing power of a dollar drops in half after 23 years. And so if you're talking about a retirement that may last that long or longer, you've got to have something in place that at least can keep pace with inflation, or help at least make sure that that client's spending, it may not have to fully adjust for inflation because people may spend less as they age, but definitely have in mind how they're going to deal with this inflation issue. And then the final issue, declining cognitive abilities. That becomes a bigger issue as people age, and especially into their 80s and 90s. where basic financial literacy becomes more of a challenge. Doing basic financial calculations becomes more of a challenge. There's been a lot of research testing this point, and so questions like, what's the bigger number, 1 over 100 or 1 over 1,000? That question becomes increasingly difficult to answer. The percentage of people that can answer it right drops dramatically as you look at people in their 80s and 90s. So trying to manage an investment portfolio, trying to stay the course and not panic after a market decline, it becomes a lot more difficult with age. One good solution to that is to work with a financial advisor who does have a succession plan in place. If that advisor is the same age as you want to make sure that that firm's going to be around. But that can help with the cognitive decline. And there's other solutions as well. But that's all this really adds up to retirees are vulnerable. If they're vulnerable to market declines, it can impact their standard of living permanently. So Dirk Cotton is a blogger at the Retirement Cafe blog, and he made this great analogy, just like what we had for breakfast today. So in our breakfast, the chicken was involved in making our breakfast, but the pig was committed. And this is the situation he applies to this problem. Pre-retirement, people are involved in their financial plans. Post-retirement, they're committed to their financial plans. So essentially, retirees need to think like pigs. They're committed to what their plan's doing. It's a whole new world, a whole new different set of circumstances. So this is another example that gets used a lot in trying to describe how retirement is different, especially in contrast with traditional wealth accumulation. With wealth accumulation, we're often thinking about how do we get to the top of the mountain? How do we reach our wealth accumulation target, whether that be $1 million or $2 million or whatever the case may be? How do we get there by our intended retirement age of 65 or whatever age that may be? But the goal of climbing a mountain is not just to get to the top. We have to get back down the mountain as well. And mountain climbers, especially probably in Denver, you know this a lot better than I even. Well, I haven't climbed any mountains, but as I understand, and as my limited experience suggests, it is harder to get back down a mountain than to get up the mountain. You're tired, you're more fatigued. The way human feet are designed, it's easier to go uphill than downhill. It's easier to slip and that sort of thing. Getting down the mountain can be more dangerous. And that analogy really applies to retirement as well. It's because of these previous slides, the issues I've been saying so far, it's a lot more difficult to get down the mountain than it is to get up to the top of the mountain in the first place. But for a client, for their financial plan, the goal is not just getting to the top there. They want to get back down, getting to the bottom successfully, not running out of money before they run out of life. That's the key of having a successful retirement plan. So here's retirement risk expressed in a different way, slightly different from the earlier slide. We have longevity risk on the top. That's the overarching risk of retirement. That's the idea that the client, we don't know how long the client's going to live. So we have this unknown but finite planning horizon for the client. Now, if someone's retirement is short, unfortunately, they don't live very long. The silver lining in that, if there is one, is their financial plan was not very, or their retirement was not very expensive. If you only, unfortunately, make it a few years into retirement, it doesn't cost a whole lot. So, and there's also not much time for other risks to become an issue. It's when somebody has a very long retirement that they have to fund more years of spending, it becomes more and more expensive to do that, and there's more time for all these other risks to become a problem as well. So that's why longevity risk is on the top here. Then the other sets of risks include macroeconomic or market-related risks, investment volatility, sequence of returns risk, which is going to amplify the impact of investment volatility, interest rate volatility for the bond holdings and so forth, and public policy, taxation risk, changes in tax laws. We saw a good example of that last November when the file and suspend rule started to be phased out with Social Security, so that a lot of your clients may have had a plan to get an extra $50,000 or so out of Social Security, and that's being phased out. That's the kind of example of how these kind of macroeconomic type things can impact the financial plan. Inflation is also macroeconomic, but I list it separately for the reason already I said that, of course, hyperinflation is going to destroy a financial plan, but even a low stable inflation rate that wouldn't imply any sort of macroeconomic problem is still going to be an issue for a long retirement. And then the personal spending shocks, so healthcare, long-term care expenses, having to help other family members, the expenses for divorce or fraud or theft, all these types of issues. Spending shocks that were not planned for, but that need some sort of contingency in place to be able to deal with them. Okay, so this is the chart about the lifetime sequence of returns risk, where I'll get into a little bit more detail about sequence of returns risk. What I'm showing here is somebody who's, in this case, investing in the S&P 500 over a 60-year period. So it's year 0 is not necessarily the year they were born. To give some simple numbers to this, maybe they start saving for retirement at 30. So years 0 to 30 here would represent ages 30 to 60. They retire at age 61 and then have a 30-year retirement. So years 31 through 60, that's their 30-year retirement. So they're invested in the stock market over a 60-year period, but it would be a mistake to then just conclude 60 years is a long time. Now there's not a lot of historical examples of what happens over different 60-year periods, but at least with the data we have, usually the average stock market return over any 60-year period is pretty decent. But we can't necessarily rely on that. What we're showing on this figure is the relative importance of each year's market return on the overall financial plan over their lifetime in terms of how much are they going to be able to spend in retirement. How important is each year's market return to explaining ultimately how good is it going, how good will their standard of living be in retirement. So each year for the first 30 years they're going to save.
What's the units on the graph there? Is it 16%?
Yeah, those would be percentages. This is from just a simple regression. It's the explanatory power of each year's market return on the dependent variable being the kind of sustainable spending in retirement. And you don't have to worry so much about exactly what that means. The issue is just more the relative importance of each year.
And does this also assume that somebody has the opportunity to continue to work longer if they want to? That
Well, no, not in this case.
Retirement dates.
Right. For this calculation, there's no flexibility in the retirement date. This is just simply they work for 30 years, they're retired for 30 years. So delaying retirement can be a strategy to help control sequence of returns risk for sure. But this is really just to show sequence of returns risk without that added flexibility built in. So each year for 30 years, they're adding new savings into their portfolio. They start at year 0, they have nothing. They start saving every year. So naturally, the market returns in the early years of their career don't have much importance. It's only impacting a couple of years worth of returns. Each year they're saving more, so year 30 becomes the most important market return of their pre-retirement period, because that market return is impacting 30 years worth of contributions. The portfolio is hopefully getting to be at its largest size at that point. That means a given percentage returns having a bigger impact. A 10% market decline in year 30, if they have just $1 million at that point, that's $100,000 of losses that it may have taken them the first 10 or 15 years of their career ever to have $100,000 in the first place. So year 30 becomes the most important market return for their pre-retirement phase. Year 31, the problem changes because they're no longer, so there is sequence risk when you're in the pre-retirement phase. It's whenever you're adding new contributions or taking distributions, there's sequence risk. There's only non-sequence risk if you invest a lump sum amount. You can put $1 in the market and see how much it grows after 30 years. Then the order of returns doesn't matter. But when you're adding new contributions every year, the order of returns matters. And then the problem changes in year 31. They now start to take distributions, take out from their portfolio rather than add to their portfolio.
Are you assuming constant real spending here?
Yeah, this is assuming constant real spending. So this is to just explain sequence risk. There's a number of different solutions for sequence risk. Being flexible with spending is a way to help manage sequence risk. For the time being, this is to just kind of show, if you're trying to have, the question in retirement is how much constant real spending can they sustain over a 30-year period? And this is showing how important is each year's market return to explaining how much constant real spending can they sustain over their 30-year retirement period. So the year 31 market return is by far the most important. The issue here is when you're trying to fund constant real spending, you start to dig a hole for the portfolio that it becomes difficult to recover from, even if the markets recover. So for example, if you start with a 4% spending rate and your portfolio drops in half in your run of retirement, you're now suddenly at an 8% spending rate to be able to maintain the same spending level. And then your portfolio has to earn at least 8% just to keep pace with where it is right now. To ever actually recover to where it started from, you'd have to earn a lot more than 8%. And so then that becomes a hurdle, because every year you'd have to consistently earn a very high rate just to recover that ground. So that even if the market recovers and we don't have an economic catastrophe, sequence of returns can cause a bigger issue for retirees who are taking distributions from their investments. Each successive return becomes relatively less important. In separate analysis, I calculated the first 10 years of a 30-year retirement. The market returns during those first 10 years explain 80% of the outcome of how much they're going to be able to spend. The last 20 years, therefore, don't explain as much. Basically, either your plan's going to be successful or not by the, well, look at years 50 to 60. It's like, it doesn't matter what the market does anymore at that point. And we can see an example of this. So we have the 4% rule. That's William Bengen's research from the 1990s, where he looked at different rolling 30-year periods in history, 1926 through 1955, 1927 through 1956, and so on, and just calculated for a hypothetical retiree in each of those years. What percent could they have withdrawn and sustained that over a 30-year period with inflation adjustments? And the worst case scenario in our US historical record for a 50-50 portfolio was 1966. So that was somebody getting the market returns from 1966 through 1995. That's the worst case scenario in US history. But just think about those years. The problem with 1966 through 1995 was the first half of that retirement. It was a tough market environment, especially after inflation, until about 1982. There was a big market decline in 1973 and 1974, so not right away. But high inflation and stagnating markets was really the issue until about 1982. And then the markets took off and boomed 82 through 95. But for that 1966 retiree, hypothetical person, it was already too late by 1982. Their portfolio had been so they were still on track to generate our worst case scenario, despite the great market gains made over the last half, approximately half of their retirement.
So what withdrawal rate was sustainable over that worst 30-year period?
That was the 4% rule, that 1966, just slightly more than 4% for a 50-50 portfolio. And that means in every other hypothetical 30-year investor, the withdrawal rate was more than 4%. 4% was the worst one. Okay, so as we transition from the defined benefit pension world to the defined contribution pension world, pension managers could pool and manage risks in two ways that individual investors cannot with an investment portfolio. So a pension manager can pool market return risk. The defined benefit pension is not based on how much do you accumulate in your individual account. It's based on some formula applied to your salary, whatever that formula may be. But two workers who work at different times, have the same basic salary, are going to get the same pension. Now behind the scenes, if they would have had an individual account, they could have had very different outcomes. One, if their contributions into their defined benefit pension would have been in an individual account, one person might have ended up with $3 million, another person might only end up with $900,000. And that kind of gap, that's a realistic gap for this, what sequence of returns risk can do with historical market returns. So that risk gets pooled though, because if the actuaries were involved and are able to make good assumptions, the defined benefit pension can be sustainable over the long term if they basically get right what is the average market return going to be, what is the average longevity going to be. And then everybody can get their defined benefit pension like they got an average market return. In the defined contribution world, some would have been able to do much better than their defined benefit pension. Some would have done much worse. But the pension's pooling that market risk across different cohorts of workers working at different times. And then longevity risk, naturally defined benefit pension pools that risk. That's this issue of individuals not knowing how long they're going to live, Well, if the actuaries were involved in the decision making and were able to estimate things correctly, the defined benefit pension can be sustainable as long as politicians or company managers don't get involved and make unrealistically optimistic assumptions that help today but hurt in the future. I mean, if it's done correctly, longevity risk can be pooled through the mechanism that those in the plan who don't live as long subsidize those who live longer. So that everybody in the defined benefit pension gets a pension based on living to their life expectancy. So at age 65, if that's approximately about 20 years, everyone in the defined benefit pension gets paid like they're going to live for 20 years because there's this ability to subsidize from those who don't live the full 20 years to those who live more than the 20 years. In the defined contribution world, there is no pooling available to do that. And how do we treat that? Well, that is in that 4% world. The 4% rule is trying to manage investment risk and longevity risk by being conservative. They're trying to manage the investment risk by saying the 4%, that's connected to our worst case scenario. We can think of that as like the worst case type market. In this thinking, we'll think of that as kind of the worst case market returns we might expect. So let's make sure our plan's going to work with poor market returns. And then 30 years was meant to be a conservative planning horizon, which in 1994, when William Bengen did that research in 1994, he was thinking a 65-year-old couple, it's unlikely that a member of that couple will live beyond 30 years. Now, longevity continues to improve so that we're no longer in a world where 30 years is all that conservative. But at the time, it was meant to be conservative. And that was meant to be how you manage longevity risk. By selecting a long enough time horizon, that is unlikely the client will live beyond that time horizon. Just one more note about the 4% rule and how you can see how sequence risk amplifies investment risk. From that 1966 to 1995, the compounded real return on that 50-50 portfolio of stocks and bonds, that's S&P 500 and intermediate term government bonds, the compounded real return over those 30 years was 4.2%. But if you just play around with the PMT formula in Excel of just how much can you sustainably spend given a market return and a time horizon, 4% inflation-adjusted spending implies a compounded real return of 1.3%. So the actual average market return over that 30-year period that gave us the 4% rule was 4.2% compounded real return. But that retiree only got to spend like their compounded real return they experienced was 1.3%. That's the amplification caused by sequence risk. And it can work in the other way as well. If you get a good sequence of returns early on, maybe your compounded real return over the retirement was still the same 4.2%, but maybe you could have spent at a rate like you were getting a 6 or 7% real return. Sequence risk amplifies traditional investment risk. And in our defined contribution world, there's less avenues to manage these types of risks with an investment-only type portfolio. Okay, so these are the goals of retirement, the 4 L's of retirement: lifestyle, longevity, liquidity, and legacy. Lifestyle is just being able to fund your full lifestyle spending goal over your retirement, or being able to fund your full lifestyle goal. Longevity over your whole retirement. Liquidity is having assets that are truly liquid, that are available, that have not been earmarked for some other goal on the household balance sheet, that can be used for unexpected expenses or other contingencies. Having true liquidity. And legacy, just wanting to leave a legacy. An important point about liquidity too is that when it comes to retirement income planning, we really have to distinguish between 2 types of liquidity. Because we often hear the argument, I want all my assets in an investment portfolio because it's liquid. So just recall back, think about again, this 4% rule that we have as a basic guideline for retirement income planning. Let's make a simple problem. Our client wants to spend $40,000 inflation adjusted, and they have $1 million in their portfolio. It's invested in stocks and bonds. Does that client have any liquidity? So in a sense, yes, they can rebalance their portfolio, they can do whatever they want with those assets. But in another important sense, the answer is no. They have to earmark that entire $1 million to fund their $40,000 spending goal. While they could use that $1 million for something else, doing so jeopardizes being able to meet their $40,000 spending goal. So in a sense, those assets shouldn't really be treated as liquid because they are needed to cover the spending goal. So is there a better way to cover that spending goal more cheaply that would really allow for true liquidity, where you have less assets earmarked for the spending goal? And one of the answers to talk about in this is the idea of income annuities. This is the kind of term life insurance of the annuity world. It's the only people who talk positively about them are academics, because they're the cheapest, lowest commission form of an annuity, so annuity salespeople have no incentive to sell them. They represent about 4% of annuity sales, and advisors also tend to not like them if they're charging an assets under management type of fee, because if you annuitize part of the portfolio, it does take away from assets to be managed. But income annuities are basically the equivalent of a defined benefit pension. They pool the market risk, they pool the longevity risk. They can potentially offer a higher payout than what you have to assume will be possible with the investment portfolio. Because if you're managing the market and longevity risk in the investment portfolio, you have to assume you're going to get poor market returns, you have to assume you're going to live a very long time. And so the spending rate that you ultimately suggest to the client may be lower than what you could get through an income annuity. So if you could cover their spending goal more cheaply with the income annuity, then so that for example, if there's an income annuity that gives you a 6% payout rate, just very simple examples here, then you don't need that whole $1 million to cover the $40,000 spending goal. You can calculate how much of those assets do you need to cover that $40,000 spending goal. And then you might have $200,000 or $300,000 left over. That would then be truly liquid because it's no longer earmarked to cover the spending goal. It could be used for other purposes. It could be invested more aggressively. And back to that issue of longevity risk, if that client has a short retirement, partial annuitization may lead them to have a lower legacy when they would otherwise both ways have a fairly decent legacy because their retirement didn't last long and was not so expensive. But should they live past life expectancy, their legacy, the legacy value of their assets can be bigger with partial annuitization because living beyond life expectancy is giving them access to a source of returns that the investment portfolio doesn't provide. And that's those subsidies. The subsidies coming from those who do not live as long to those who live longer. That becomes a unique source of returns for those who live beyond life expectancy. That allows them to take less distributions from their portfolio and to leave a bigger pot of assets in the end, so that in the long term, they will have a larger legacy, conditional on living beyond life expectancy. If they don't live to life expectancy, they can't expect as big a legacy because they entered into this risk pool. They were willing to give up some of their assets for the ability to get that subsidy should they live longer. But in any event, should they not have a long retirement? Again, we're in a situation where the heirs are still going to get something because they were planning to live 30 or 40 years or whatever the case may be, and if they only made it 10 years, hopefully there's still money left over after 10 years. Probably still a lot of money, so the heirs are not necessarily going to be harmed to a great degree. It's 20 or 30% of their portfolio. And that's the idea of liquidity. So there's a liquidity in the sense that you can rebalance the portfolio, but that doesn't really mean a whole lot for meeting a retirement spending goal. And then there's the true liquidity of you have assets on your household balance sheet that are available for whatever you want to use them for. They haven't been earmarked. They're not being held hostage to cover some sort of liability, some sort of spending goal on the balance sheet. Okay, if you see the slides as well, now we're going to talk more about investments and insurance. And really, I think best practices for retirement income planning, it can't be investments only, and it also can't be insurance only. It's got to integrate the both. And so these different investments and insurance work differently in meeting retirement goals. I'm not going to go into detail about these slides. It's getting a little bit off track. But they're on, if you just want to see the slides later, you can use this as a reference. And also this is really just a reference because I don't think you can see it. It's my attempt to summarize the retirement income planning problem on one slide. And so what we have here is the process is we want to combine available retirement income tools to best meet our goals and to manage our risks. And then retirement goals, I have 6 things listed here, but they're ultimately just wordier versions of the 4 L's. Lifestyle, longevity, liquidity, legacy. And then different risks, well, most of these risks are different types of spending shocks. We have the same basic risks: longevity risk, market type risks, public policy risk, inflation risk, and a bunch of different spending shocks that you need to have a plan to cover: long-term care, health care, and so forth. And then a list of different income tools. And this is just trying to be as comprehensive as possible of all the different types of income tools clients may have available. Their investment portfolios, their home equity, their insurance policies, family and community support, social security benefits, if I didn't say that yet. Just everything available that they can draw from business holdings, rental income for clients who do have that as well. Everything available to them to build a retirement income plan. And so I started to introduce this discussion about investments and insurance. And that's a general way to kind of delineate between, there's actually these 2 completely different schools of thought about how to build a retirement income plan. Saying one school of thought's investments and the other insurance is too much of a generalization, but it's getting at the heart of the idea. I call these schools of thought the probability-based school and the safety-first school. The probability-based school is going to be much more related to what investment managers and wealth managers do. The safety-first school is going to be more related to what the insurance side would be suggesting. But ultimately, I think we can take aspects of both of these to get a good retirement plan. So these 2 schools of thought, you can ask basic questions and get opposite answers. So as investment managers, they all question, do stocks become riskier or less risky in the long? Are stocks less risky in the long run? The probability-based side would generally say yes. Over longer holding periods, stocks become less risky. The safety-first side would generally say no. Actually, the risk of holding stocks becomes greater over longer holding periods because the range of potential outcomes becomes broader. Even though the average cumulative return, or the average compounded return may narrow over time, the range of actual outcomes can get wider. So they're going to give opposite questions. A question that's on here is, what's the safe withdrawal rate for retirement? The 2 schools of thought will give completely opposite answers. So to just talk briefly about some of these issues, how do these prioritize amongst retirement goals? So the probability-based sides, and so you can think of yourself as an advisor, which side do you tend to fall into? Because most advisors will fall into one or the other. But also, when talking to clients and prospects, it's important to understand both, because though clients and prospects may not articulate this, they're probably either a more of a probability-based person or a safety-first person. So maybe even before going into detail about this, a further step back, if you're like a lot of financial planners today working with clients, you run a Monte Carlo simulation for their financial plan. Suppose you run that simulation and the plan reports a 90% chance for success. A probability-based client is okay with that. 90% chance, those are pretty good odds. And it's understood maybe, there's a 10% chance the plan will fail, but probably we can just make some minor adjustments along the way. We're working together with this advisor who's going to know when the plan may be on not the best trajectory, so we'll be able to make a few adjustments, keep the plan on track, and end up okay in the end. That's the thinking for a probability-based client. The safety-first client is going to say, a 90% chance for success, I don't like that. What can we do to get a 95% chance for success? Or they might even say, what can we do to get a 99% chance for success? Or even, what can we do to get a 100% chance for success? Which should never, nothing should ever be reported as a 100% chance for success. But that's kind of the mindset that this safety-first client is going to be coming from. And so you hear a lot of analogies about this, like who would board an airplane if you knew there's only a 90% chance it would get to its destination? But that's the idea there, that not comfortable with failure. And so what is the mechanism? If you run the plan for the client, it's got a 90% chance for success, you want to get it up to a 95 or 99% chance for success. Well, you could tell the client to work longer as an option. You could increase the assumed investment return, which is an option that would improve the chance for success, although it's not necessarily a good idea to do that. Or ultimately, you just tell the client, okay, well, for example, if we have you, every year you're going to spend $120,000, let's run this plan spending $110,000. Okay, that's 94% chance for success. Okay, let's cut spending another $5,000. Okay, there, now, if we cut your spending $15,000, there's your 95% chance for success. That's pushing the client to be more conservative with their spending to get a probability of success that they're comfortable with, because that's the only lever we have with an investments portfolio. We have to essentially assume lower market returns. Like you can reverse engineer Monte Carlo. Having a 90% chance for success is just assuming a lower market return. And that's essentially what you're doing to get that probability of success higher. And of course, hopefully nobody's really just using a spreadsheet anymore where they plug in the historical average and say, okay, on average stock markets give you 7% after inflation, so I'll plug in a 7% return in the spreadsheet. Well, if that was the correct average return, the average return only gives you a 50% chance for success. Half of the time the returns would be less than that. Half of the time the returns would be more than that, even if that's the long run average return. So naturally, to get a higher chance for success if you're using Monte Carlo, it's not the average return that we're talking about. It's something much less. And that's the only lever you have, is cut spending, because you have to assume lower and lower market returns to get the higher chance for success. So that's how clients could approach this. Now, in terms of these other points, how do they prioritize amongst goals? The probability-based side tends to focus more on what is the overall lifestyle spending goal of the client. How much do they want to spend? So, and there's a lot of advisors who talk about this in the press. They'll say things like, have you ever sat down with a couple and argued about whether the cable bill is a essential expense or a discretionary expense? Or if the client couldn't stay in their country club, really that's probably discretionary, but for that client that's really part of their lifestyle. They may really feel like their retirement was not successful if they can't meet their full lifestyle. So probability-based is generally going to focus on the overall lifestyle. Safety first, though, is going to make this distinction. They're going to want to go through the client's budget, figure out what are the essential expenses that we want to meet with almost no chance for failure, and then what is more discretionary, where we might be willing to accept some chance for failure and distinguish between these types of expenses. That's important because then it leads to a different investment approach. The reason I call probability-based is because it's going to try to build a total returns multi-asset class diversified investment portfolio to give you the highest, figure out what asset allocation is going to give you the highest probability for success to meet an overall lifestyle goal. And the more aggressive that lifestyle goal is, like the higher percent of assets you need going, whether it's if they can meet their goal with a 2% distribution or a 4% distribution or a 6% distribution, the higher the distribution rate they need, the more aggressive the total returns portfolio needs to be to maximize success. Although the maximum success rate might be low. It might be with a 6% spending rate, maybe you can only maximize success with about a 60% chance for success. But it's probably going to be 100% stocks that does that. It's not considering the magnitude of failure or that you might run out of money sooner in some cases, but what's just giving you the best shot at meeting that goal. The safety first side is approaching this differently though. They're using more of the tools coming from the pension management world, asset liability matching, taking the balance sheet and matching assets to liabilities in a way that keeps risk levels comparable. So for the essentials, they're not really going to want to have those assets in the stock market. They're going to want to have some sort of contractual guarantee behind it. It doesn't necessarily have to be an annuity contract. It could be holding individual bonds to maturity, where you then have the contractual guarantee behind the bond. Of course, there's default risk. But it could also be, that's where insurance, annuity type solutions, contractual guarantees for the essentials. And then for the discretionary part, that's where you have a more aggressive portfolio. Yes?
Do you take into account taxes somewhere in there? Because after 17.5, that person who rolls over their 401k is going to be paying a hell of a lot of money in taxes.
Yeah, so taxes should be part of all behind it. That should be part of the essential expenditures category. Fixed expenses like shelter, taxes, basic living, quality of life, food.
If he accumulates in his 401k, his tax bracket's probably going to go up once he retires also.
Mhm. Yeah, so there's trying to develop efficient, part of building a good retirement income strategy is to focus on tax bracket management as well. So maybe opportunities for Roth conversions. If somebody is retired by 62, so that they don't have any labor income, it can be a really good idea for, not just for other reasons, but for tax reasons, to delay Social Security to 70, so that you have as little of an income as possible for these next 8 years, and then do these Roth conversions. Now it depends, wealthier clients will get less benefit from this, but for a middle-class client, they might be able to get a lot of their IRA moved over in the 15% tax bracket. That jump from the 15% tax bracket to the 25% tax bracket is huge. So this, being strategic to try to always stay in the 15% tax bracket can be a big help to a client. For wealthier clients, there's less you can do here, but yeah, definitely that's got to be part of the analysis. Okay, so that's, and then the discretionary expenses, that's where you have your more traditional diversified multi-asset class portfolio, but you could consider how it could be more aggressive because you do have the essentials covered already. So it would be more aggressive than a standard, whatever it was for the total returns case. How do you measure retirement success? Probability based is just trying to minimize failure, probability of failure for the plan. Safety first is making that distinction and to try to have contractual guarantees so that in the worst case, you still will have the essentials covered. And then only focus on this idea of a failure rate for the discretionary part. So what's the safe spending rate from an investment portfolio? Probability-based really falls in line with William Bengen's research from 1994 that's been consistent. The historical record suggests 4 or 4.5% is about as bad as it gets. So that's going to be viewed as a safe spending rate. The safety first side says inherently that that's a contradiction. When you're talking about an investment portfolio, and that 4% rule is linked to having 50 to 75% stocks in retirement, there's inherently no such thing as a safe spending rate to have constant spending from a volatile portfolio. Risk is always going to be there. And just because something worked historically doesn't mean it's always going to work in the future. So they're not going to want to take that sort of risk, at least for the essentials. Now in the real world, there's a lot of different approaches to retirement income planning. And they can mostly be put somewhere on the spectrum between a pure probability-based approach and a pure safety-first approach. So in some sense, the 4% rule concept, that's a pure probability-based approach that likely no one in the real world really does to a T, because it makes no adjustment for how the portfolio is doing. You're just playing this game of chicken with your portfolio. You keep adjusting your spending for inflation even as your portfolio plummets towards zero, because you're just sure that your portfolio is going to make it for that whole 30-year period. Of course, if you live beyond 30 years, that's another issue. But the safe withdrawal rates, the 4% rule world, that would be pure probability based. And then just different variable spending strategy, like Jonathan Guyton's decision rules and that sort of thing, adjusting spending to market performance, but still mainly sticking only with investments would be a next step. Then time segmentation or income buckets, where you have different investment strategies for different time horizons. Usually you have fixed income to cover the first part of retirement. You have a more aggressive portfolio to cover the later part of retirement. You have some mechanism so that over time you bring assets from the later bucket into the earlier bucket to extend out your earlier bucket. But that's trying to build in some protection from sequence of returns. It still tends to be more of a probability-based approach because it's generally reliant on the idea that stocks are not as risky over longer holding periods. So it's relying on the idea that if you can leave your stocks alone for 5 or 10 years, they're going to do pretty well before you ever have to sell them. But nonetheless, it's starting to build in some sort of functionality to deal with sequence risk. And then we're getting into the middle part where I think some of the more promising solutions are. And really the approach that I think best fits is product allocation, which Moshe Milevsky up in Canada introduced this with an article in 2003, looking at not just asset allocation and how do you take your systematic withdrawals from your investment portfolio, but how can you combine in income annuities as well? How can you also combine in other types of more complex and expensive annuity products, which, as I'll talk about, I mean, those other complex and more expensive annuity products, I don't find much going for them. They tend to be, the more efficient way to build strategies tend to be to build these components separately rather than take a pre-existing product that tries to bundle it all together in one package, because that one package usually ends up being pretty expensive. And then the rest of these are filling out the spectrum, but in practice, not a lot of people have much interest in doing. There's been a proposal where you build a bond ladder to cover the first 20 years of retirement and then have a deferred income annuity kick in to cover years 21 and beyond. The floor leverage rule is actually really just more of a hypothetical. I don't think it's like have 85% of your assets in fixed income to build a lifetime income floor, have the other 15% of your assets in a 3 times leveraged portfolio to try to simulate approximately a 60-40 portfolio, but with more downside protection. Managed DC, that's this Robert Merton's suggestions, the Nobel Prize laureate who works with dimensional fund advisors, where they've moved away from the original idea of having everyone basically invest in TIPS pre-retirement and then buy an inflation-protected income annuity for post-retirement. But that would be, the pure form of that would be the closest thing I've seen to this pure form of safety first. You get quote on this pure safety first side, like Zvi Bodhi at Boston University has said, most Americans should be invested in TIPS and I bonds alone. That's pure safety first. And his reason is most Americans have not saved enough so that they can safely cover all their essentials, so they have no business being in the stock market. That you should only start getting into the stock market once you basically have enough assets to cover your essentials. And until you've done so, you're only TIPS and I bonds. Now, to his credit, Orton, he said that actually at a time that TIPS yields were in the 3 to 4% range for real returns, which is actually really great. And if that existed today, that's where I put all my money right away. But now, of course, TIPS yields are now 1% or less. So it makes it very expensive to go that route. But that's kind of the logic, though, of the safety first approach, that you're taking too much risk to be able to cover your essentials if you don't have, I mean, with the stock market, if you don't have, you need to cover that more safely. Okay, so then the Financial Planning Association they offer basically 3 approaches to retirement income planning that can fit into that spectrum that are basically the 2 schools of thought. Systematic withdrawals is what I was calling safe withdrawal rates, and it can include other variations of that. Time segmentation, that's this bucketing approach where you have a different investment strategy for the short term and a different strategy for the long term. And then essential versus discretionary is where over the lifetime of the retiree, you have a different investing strategy for essentials and a different strategy for discretionary. So systematic withdrawal is going to look like this. Here's the retirement date, here's the age, here's their spending up to their lifestyle goal. Basically, you'll cover that all with the traditional, as close as we have to like modern portfolio theory, the traditional diversified multi-asset class investment portfolio. That got started, as I've already been talking about this, the William Bengen's article in 1994 that developed this idea of the 4% rule. And I've already talked about this earlier in the presentation, so I'm not going to spend much time here. But he was responding to this idea in the popular press in the 1990s. And this is the same thing. Dave Ramsey's still doing this today. Dave Ramsey even does a more extreme version of it. But what the less extreme version was, historically in the US, the S&P 500 has given you a compounded real return of about 6.5%. So if you plug that 6.5% real return into a spreadsheet, it implies every year your portfolio grows 6.5%, you take out 6.5% to spend, you basically 6.5% is a safe spending rate, and you never dip into your principal. If you're willing to spend on your principal, you could even be looking at 7 or 8% spending rates as safe. And he thought, no, that doesn't sound right. And so what he did, gave us this idea of sequence of returns risk as it's used in the financial planning world. He took the historical data, and I already explained to you, he looked at different 30-year periods thinking that that's a reasonable, conservative planning horizon for a 65-year-old couple, and just asked, in this case, with a 50-50 portfolio, what would have worked over different 30-year periods? So in 1926 and 1955, 7% was a safe spending rate. You could have taken 7% of your portfolio, adjusted it for inflation, adjusted that amount for inflation, and sustained that spending level over the next 30 years. And then your portfolio hits zero in year 30 of your retirement. But there's a lot of volatility around that. And so what he focused on was, what was the worst case scenario? He called it the safe max, the maximum safe spending rate in the worst case scenario. That's that 1966 retiree, just slightly above 4%. And so then the implication is retirees should use a 4% spending rate for their retirement. Now, in every case but this, 4% ends up being too conservative. So it means their assets will continue to grow. And if you look at the real purchasing power of wealth, if you used a 4% spending rate for all these different historical retirements, more than half of the time, you'd have more assets in inflation-adjusted terms at the end of 30 years than you would have had at the start of that retirement. So it's a conservative spending rate. Although I do worry it's not conservative enough, but the idea of it, it's a designed to work in the worst kind of market environments that we can imagine. And as I was already saying earlier, over these next 30 years, 4.2% real was the compounded return on that 50-50 portfolio. But the fact that they only got away with using 4%, the internal rate of return on that, it was really like their portfolio only earned 1.3% real. And that's because of the disproportionate impact of the early returns relative to the later returns. So that's how the probability-based view of retirement exists. It's this multi-asset class investment portfolio building the spending for retirement. This is the closest to, this would be the approach of traditional wealth management, not necessarily taking all that much difference from what they were doing, what you're doing pre-retirement to what you do post-retirement. Unless you are just working with the financial planning software, running Monte Carlo simulations, then you might be guiding asset allocation more on what do you need to do to meet the goals. But it's still the same basic idea. You're using modern portfolio theory to get the specific asset allocation for that portfolio. Okay, I've for the most part talked about these issues already thus far. This is the logic of the 4% rule and then some of the issues with it. So some of the issues is, of course, we could have a new worst case outcome. That 1966 doesn't necessarily have to be the worst year ever. There can be a new worst year to retire. 30 years really isn't so conservative for a 65-year-old couple anymore. Probably 35 or 40 years is more equivalent to what 30 years was in 1994 when he did the research. So as I was just saying, the 4% rule, usually spending is too conservative. But at the same time, you're still exposing the client to risk of portfolio depletion if the spending rate does end up being less than 4%. And it doesn't have to be an economic catastrophe to cause that. It's this sequence of returns risk issue that a few badly timed years in the wrong point of a person's retirement can disrupt that plan. Now the 4% rule does assume constant inflation-adjusted spending, which actually is a unique cause of sequence of returns risk. If you let the spending fluctuate with the portfolio performance, you mitigate the sequence risk. Actually, at the extreme, so the 4% rule is not spend 4% of whatever's left every year. That's a different kind of spending rule. But a rule like spend 4% of whatever is left in every year, there's actually no sequence risk with that. Just like there's no sequence risk with investing $1 for a long holding period. So at the extreme, having spending fluctuate completely with the portfolio's performance eliminates sequence risk. But then strategies the problem with that is it's hard to have a budget. If you don't know how much you can spend next year until you know what your portfolio does this year. So all the work at trying to find rules to guide spending in retirement are trying to develop a compromise between try to keep spending as stable as possible, but also have a mechanism built in to adjust spending when absolutely necessary to try to help mitigate sequence risk in that way.
Has there been any research done to try to link the safe withdrawal rate with, say, a current PE on the S&P 500 or anything along those lines?
Yes. There's Michael Kitces has done work on that. I've done some articles on that as well. I have an article about safe savings rates that actually uses that mechanism, because Shiller's cyclically adjusted price earnings ratio, Robert Shiller's been talking about since the 1990s. It explains about 30% of the subsequent 10-year stock market return. So it's not a great relationship, but it actually does a better job explaining like the 30-year safe spending rates. Higher market valuation levels imply lower spending rates. Lower market valuation levels imply higher spending rates. But the same thing exists pre-retirement as well. If you're retiring when the market's overvalued, that means you should have a lot more wealth because you've been enjoying that ride up. If you retire when the market is undervalued, then you may not have so much wealth. So somebody who retired in 1982, you can see here, actually almost a 10% withdrawal rate would have worked for them. But you would not have had a lot of wealth when you retired in 1982. Shiller's Cape was very low in 1982. And then 1966, Shiller's Cape was not at a historic high, but it was at a fairly high level. Basically, if you're retiring at the end of a bull market, you should have more wealth, but you should also then be expecting to have to use a lower withdrawal rate. And that happened with 1966. That happens with 1929, the year that the Great Depression began. That was Shiller's Cape had gotten up to 29. It's around 25 to 26 today. I mean, we've had so much volatility the last couple of months. I think it's around 25 today, which is overvalued relative to its historical average. That would suggest lower spending rates today, especially when coupled with the low interest rates today. And that's kind of the implication. So Michael Kitces and myself had both articles in the Journal of Financial Planning on that topic. Okay, so let's just make sure we get to some of this other material. So time segmentation, I've explained the idea. We're trying to meet the whole lifestyle goal, but we invest differently for short-term and long-term. And holding fixed income assets to maturity in the short term, having the diversified portfolio for long-term. And then so eventually as retirement progresses, this bucket would get down to zero if you don't do anything. But you got to have some mechanism to pull assets from here to build out that fixed income ladder over time. And then essentials versus discretionary. Generally going to want to build in some sort of risk pooling on the longevity, so some sort of lifetime income guarantee to cover the essentials, and then the diversified portfolio beyond that. So essentials versus discretionary, it's modern retirement theory was created by a CFP in Mississippi, Jason Branning, and he describes this as essentials should be covered with assets that are secure, stable, and sustainable. The idea is not using stocks to fund the essential expenses. And there's more willingness in this world to use income annuities. Or you could use other kinds of more complex annuities as well, but the research is generally focused more on the income annuities. Again, those low-cost, not very commonly used income annuities as the way to provide that longevity protection. So here's how modern retirement theory, and it's a play on the term modern portfolio theory, sets up this problem. We've got the household's liabilities, their essentials, and then they're putting a contingency fund. These are just having contingency assets before covering discretionary expenses, and then the legacy fund. And then you match assets to liabilities to cover the risk characteristic, to match up their risk characteristics. And you have this priority. That's Svi Bodhi's idea most Americans should only be in TIPS and I bonds, is just most Americans only have enough assets that they're in this part of the pyramid. They're not getting their way up to here yet. So that's why they're not really into the stock market yet. That's the idea coming out of this funding pyramid. So here's a simple household balance sheet. for retirement. You have assets, liabilities. The liabilities are basically financial goals for retirement. Fixed expenses, so basic living needs, taxes, debt repayment. Discretionary expenses, travel, leisure, lifestyle improvements. Contingencies, long-term care, health care, other spending shocks. Legacy goals for family, for community and society, and so forth. These are the liabilities that you want to be able to fund. And then you have your assets. Human capital, so just the potential for part-time, continuing work or part-time work. Home equity, that's a big asset on a lot of retirees' household balance sheets. Their financial assets, checking accounts, brokerage accounts, retirement plans. Insurance and annuities, which wouldn't show up in their financial statements, but, well, annuities that can cover expenses, but insurance that can help with contingencies. Social capital, from part of society, our social security system, Medicare, company pensions, family and community support. And the idea is to try to figure out how to line this all up to cover all the liabilities with similar types of risk characteristics. So this is trying to then summarize this retirement income problem. We've got our 4 L's, longevity, lifestyle, legacy, liquidity. And those are going to match over to liabilities, so essential expenses covered for life, lifestyle, the discretionary expenses, the legacy, and then liquidity really means having these contingencies covered. And then we're going to try to match assets to the liabilities. So first we're looking at reliable income. So many clients may not need an income annuity, because first, okay, line up Social Security for their essentials. Do they have a company pension? That is pretty safe, not likely to disappear soon. Line that up with essentials. Then if that covers all the essentials, you're done. You could, if that doesn't cover all the essentials, then think about fixed income ladders for a time segmentation approach, income annuities for an essentials versus discretionary approach. Or if you are probability based and your client's probability based, you can use the diversified investment portfolio to try to cover essentials. So this curved arrow, that's the probability-based solution, would be willing to use the portfolio to also cover essentials. The safety-first solution wouldn't want to have that arrow. They'd want to make sure you're doing bond ladders or income annuities to cover those essentials. And then the diversified investment portfolio otherwise covers discretionary expenses and legacy. And then you've got reserves. So reserves can be insurance, health insurance, long-term care insurance, cash value on life insurance policies, just cash in the bank, home equity, and so one of the things I've been doing, annuities have bad reputations, reverse mortgages tend to have bad reputations, but I think that really is worth revisiting that issue. There's been a lot of improvements in the government program, and opening up a home equity line of credit can also be a reserve asset to cover contingencies. And then also family and safety net community resources can also be, if someone's active in a social organization such as a church or whatever the case may be, if that's a pretty secure way to help with contingencies, you can treat that as a reserve asset to cover contingencies, and trying to make sure you've got this all covered. That's the way I really think it's effective to build a retirement income plan. And this is speaking to the product allocation piece of things, because if you're thinking about income annuities, well, the way they would fit in is how much of these expenses do you want to try to cover that way? Or if that's zero, that's okay, but just make sure you understand that retirement risk is different from pre-retirement risk. I mean, the probability-based approach can be a best practice. It's just you have to be clear that retirement is different from wealth accumulation. So if you do have sufficient contingencies, and if that client has a low enough distribution rate, probability-based can be fine. You don't have to have an income annuity, but I think you just have to leave that on the table as an option. So that's product allocation I've talked about. Systematic withdrawals, income annuities, single premium immediate annuities, and deferred income annuities, which they're basically both immediate annuities. So a deferred immediate annuity sounds like a contradiction, but it's you pay a single lump sum, but the payments from that don't begin until at least a year later. These have become more popular now that the Treasury Department has the QLAC regulation, the Qualified Longevity Annuity Contract, that can help to delay required minimum distributions by allowing for a deferred income annuity to be inside of a qualified plan. So that's getting more attention, but that's the basic income annuities. And then when Moshe Molesky did this, he's also looking at things like variable annuities with guarantee riders. So in 2013, I published an article doing my own test about product allocation. And that was really the article that, ever since then, I see all this nice outcome for income annuities. I just put into a blender stocks, bonds, income annuities, variable annuities with guarantee riders. Look at all the different combinations of how you could combine them in a retirement plan and see how all those different combinations perform with Monte Carlo simulations. And then perform summarizing retirement goals down even further too. In bad market environments, how much of the client's lifestyle spending goals will be covered by their retirement plan is goal number one. Goal number two is, on average, can we preserve more liquid financial assets, either for legacy or contingencies? So I'm looking at 1,001 different combinations of stocks and bonds and income annuities and variable annuities with guarantees, and seeing how they perform with respect to meeting the spending goal in bad market environments and preserving assets on average. And this is how the analysis comes out. So how much of the spending goals can be met, how much financial assets are preserved, and investment-only portfolios are not efficient. This is like an efficient frontier for retirement income. Essentially, replace bond funds with income annuities, so combinations of stocks and income annuities are more efficient in the way that we describe the efficient frontier, just like in modern portfolio theory. Meet more of your spending goal for a given legacy level, or have more legacy for a given spending goal completion level. And that's the basic idea, that essentially income annuities act like a super bond. They get bond returns. The insurance company is investing those assets in fixed income, and the yield they pay out is based on fixed income yields when you buy them, the yield curve when you buy them. But they have this longevity component to them, where they're hedged to the client's liability. They're actually hedged to the problem that the client faces, where if they have a short retirement, they don't need as much money. If they have a long retirement, they need more money. So the income annuity is acting like a bond fund, or like a bond that essentially pays coupons for as long as they're needed. And that allows them to be more efficient for a retirement income plan than bond funds. So this is a generalization, stocks and income annuities instead of stocks and bonds for retirement. Now there are a couple practical considerations with the extreme version of that. The extreme version being that when the client looks at their financial statement, the income annuity would have a present value, but it doesn't show up on the financial statement. So all they see on their statement is 100% stocks. Now 100% stocks means something different for them now because they have their essentials covered elsewhere, but nonetheless, psychologically and behaviorally, that can be a problem. You might also want bonds to deal with some contingency spending or emergency fund type situations that weren't modeled directly in this particular research. But the basic generalization from that is, think about replacing bond funds with income annuities and keep your stocks. And then that also as well, variable annuities with guarantees, try to package everything together. Downside protection, upside growth potential, and liquidity for assets. But because of their costs, variable annuities with guarantees end up being in this area. Sometimes better than investments only, sometimes worse than investments only, but not really efficient, just too costly. It's breaking that apart, the upside potential and liquidity from the stock part. And this can be true liquidity if you've got spending covered by the income annuity, and then the downside protection from the income annuity. Break that up, but put them together into a plan, and that's a more efficient way to do this than a lot of the more complex insurance products that are out there. And on this, I talked about this earlier, but here's a visualization of it. So here's just a simple example of a client with $2 million at retirement and they want to spend $80,000 inflation adjusted. So that is a 4% spending rate. 80,000 on 2 million is 4%. And then this is not Monte Carlo. I just figured out, well, what investment return would they need so that their money lasts exactly 40 years? And then, okay, that's the investment return they're going to get. So I forget what that investment return was, but they're funding their $80,000 inflation adjusted for 40 years. Their portfolio gets the investment return needed to do that. And you can track, if they were to pass away earlier than 40 years, the legacy value of their assets. Versus a scenario where they put 30% of their portfolio into a life-only immediate annuity. One version that's just fixed with no cost of living adjustment. One version that offers a 2% cost of living adjustment, so a lower initial payout rate, but spending grows at 2% a year. In these cases, the annuity is going to cover part of their spending goal. The real part, it's going to decline in real terms over time because their real goal, their $80,000 grows with inflation. The no-COLA income annuity does not grow with inflation. But they're getting a piece of their spending from the income annuity. Whatever else they need to meet their full spending goal comes out of their investment portfolio. And then we're tracking the legacy value of their assets over time. So that's what I was saying about in the short term, they're going to leave a smaller legacy if they die early. But still, their heirs are going to be in pretty good shape here with either scenario. As academics like to say, the marginal utility of the additional wealth they get going from this kind of 1.6 to 2 million, not that much. Either way, the heirs are going to be in pretty good shape. But where this really shines is when they live longer than life expectancy. They're getting these mortality credit subsidies from those who died earlier. So they're getting this unique source of return that is uniquely helping to reduce their portfolio distribution needs. So that while this investment portfolio hits zero, as planned, based on just the fixed investment return that did that, their investment assets here are getting the same investment return, but their distributions are less because part of that's coming through the income annuity. Here's where their legacy assets are at age 105. Much better shape at this point. And here, an heir is going to be much happier being in this range than being in this range. And that's the value of the long-term planning of thinking about how an income annuity may hurt in the short term, but will help in the long term. And I think it's important in retirement income planning that people plan to live rather than plan to die. If you reject the income, and there's other strategies too. If you claim Social Security early because you're sure you're not going to make it to 70 anyway, well, that may be the case, but that's not really what the planning should be around. The planning should be around what's going to happen if you do make it to 90. Are you still going to have something there to help you? So that's this long-term perspective. These are just in the distribution rates needed from the investments to meet the whole spending goal. With investments only, the distribution rate has to keep going up. It is going up, but at a much slower rate with the annuitization.
Did you happen to know what the commission is on an income annuity?
Yeah, well, so commissions are generally in around the 2% range. The only way and that's a one-time deal. That's not an ongoing thing. So the quoted price has the commission baked into it. You have to reverse engineer what that commission probably is by looking at the yield curve and mortality tables. I did that last summer, and that was actually, so income annuities are such a small part of insurance companies' business that they don't pay a lot of attention to them. I've even heard from people that they let their interns price their income annuities. Last summer, the Society of Actuaries, longevity at age 65 had increased by 2 years with the 2014 life tables from the Society of Actuaries versus the 2000 life tables. So last summer, I used the new 2014 life tables. I tried to do my own pricing for the income annuities, because it's a present value calculation based on the yield curve and on the probability of surviving to each age to get the income. I was finding that the implied commission was around zero, that basically they were actuarially fair, probably because they hadn't yet started using the new life table. So I think generally speaking, commissions are around 2%. Much lower than any of the other 96% of annuity sales that get most of the coverage. Uh-huh.
You mentioned something that would be my biggest concern, which is the same thing that happened with like long-term care insurance, was that they mispriced it for all the baby boomers, and so you were getting a deal, but then companies are going out of business and you're not getting anything or whatever. So what's the chances of that happening? I mean, how's the regulatory background on, income annuities based on, are you going to actually get your money back in 20, 25 years for sure, or is there some risk around that?
Well, the income annuities are pretty highly regulated to be just in fixed income and things. A widespread bond default, like massive bond default, could cause problems. There are other state guarantee associations that cover up to some level. So it is nice if you can stay below the level of the state guarantee and diversify between different companies. You can never completely eliminate all of that risk. But I was going to say something else. I completely blanked on what I was going to say next. So, I mean, that is something to have some concern about. But, I'm sorry. but yeah, stay under the state guarantee levels. And yeah, sorry.
What about the
Sorry.
total financial impact on a company that typically doesn't have very much money in the income annuity anyway?
Right.
So that's only a small percentage of their margin, and they wouldn't lose very much if they did lose money.
Right. So it could be a small part of their business. The thing I was going to say that I remember now was also the other risk is a substantial improvement in longevity. So that if we cure cancer or something and people start living 10 or 20 years longer.
Yeah, that's what I was.
So insurance companies have a natural hedge with their life insurance business. If everyone starts living longer, they'll have less life insurance payouts, but higher annuity payouts. And so there is a natural hedge there that can help for that regard, some of it. I mean, there's no way to completely eliminate the risk. There's nothing that's truly 100% safe. But I'm not too concerned about this sort of credit risk on the income annuity. As long as, pick a highly rated company. Don't pick the company that offers the best payout rate if they're don't have good credit rating. Yes?
Given the low yield environment, what are the, practically speaking, what are the payout rates today on income annuities?
So for a 65-year-old couple with with the inflation protection, it's under 4% for a 65-year-old couple. But that I also worry 4% is not safe when interest rates are so low. So around 3.5% to 3.8% in that range. Without the inflation protection for a 65-year-old couple, around 5.6%. And I think in practice, there's very few companies that offer inflation-protected versions. So I do favor the non-inflation protected versions to get an income level today at a cheaper amount, smaller percentage of assets. Leave more assets in the portfolio, try to cover inflation more that way. It does add a little more risk, but you could ladder in the purchases over time to get more inflation-protected income that way. So that's one other point about the low interest rate world. For somebody who's already retired, there's no way to get around low interest rates. And the argument that you should not buy an income annuity today because interest rates are low, I don't think that's a viable argument for somebody who's already retired. That's fine for somebody who may be thinking about a deferred income annuity and who's still 20 years or 10 years from retirement. But for somebody who's already retired, no matter what they do, they're having to take distributions. If they're waiting for interest rates to go up before they buy an income annuity, well, they're spending from their assets. If they're bond funds, as interest rates start to go up, they may have capital losses that they're locking in. In the future, having a higher payout rate from the annuity because interest rates go up, multiplied by their lower account balance at that point, they may not get more income from waiting. So I think actually when interest rates are low, income annuities become more attractive, not overall, but relative to other opportunities, because that makes the mortality credits all the more important. No matter what somebody does, interest rates are low, and that's baked into what they're doing. They're going to get lower yields from their bonds and so forth. So mortality credits become more important. For somebody who's already retired, it's not necessarily advantageous to try to wait out for, if they do want an income annuity. it's not advantageous to wait for interest rates to rise before doing that. I mean, it could work out to their benefit to wait, but it could very easily not work out as well. Yes?
What would you change on that if you were already retired?
Change on,
your four Ls. How would you structure the portfolio if you were retired?
if you if you were retired? Yeah, that's what this was all thus far really assuming you were at the retirement date. Oh, so if you've already been retired for a while and are looking to make changes? Well, you can.
Not necessarily want to make changes, just want to know if you're right.
Well, just do an assessment of where is that person today? What's their distribution rate from their assets today relative to where they were when they started off? And just kind of, you could kind of approach it, even if they're already retired, you could think about hitting the reset button and just evaluating if this was their retirement date today, what does their financial picture look like? I think then the same sort of analysis would follow from that. Uh-huh.
It seems all the retirement research uses kind of investments like the 50-50, the banks that all uses total return. Have you ever looked at, or do you know if anyone's ever looked at the idea that investment returns, have different sources, dividends, one-year stocks are obviously much less risky than capital appreciation, if you look back in time, and then on bonds, it's interest, income.
Yeah, so getting a higher yielding portfolio and living off the income. Certainly, anytime you see an article about the 4% rule on the internet with a comment section like Yahoo Finance, everyone's going to be saying, that's ridiculous, I've built this dividend portfolio, I'm getting 6% dividends. So I don't have to worry about this 4% rule at all. The only research that kind of has explored that I'm aware of is work that Vanguard has done. And they've demonstrated in their research that higher yielding portfolios tend to have a lower total return because they're riskier. They're not the total returns portfolio at that point. They're leaning more into the value side. And for bonds, they're leaning more to higher yield, so more credit risk, longer maturity type bonds. And in terms of a total return, you might get the higher yield, but not necessarily a higher total return. And so in that regard, may not be better off. But that is definitely an area that I think more research needs to be done. The Vanguard research is all I'm really aware of. And it's not something I've tried to explore much myself.
Yeah, because I wasn't even thinking higher yield, just like market yields on stocks. But if you go back over to 1926, every year there's been a positive dividend payout from the market.
Yeah. Well, an interesting thing about the 4% rule is for most of that historical period, that 50-50 portfolio was generating more than 4% of income. And that kind of S&P 500 intermediate term government bond portfolio is not generating anywhere near that much income today. So it does require principal as well to meet the 4% spending rate. So yeah, I mean, I think it's a viable alternative to go that route, but I don't think there's been really a lot of research that has been able to quantify or and maybe there's risks involved, but it could work. It could be listed as a viable alternative. Just I can't comment too much more beyond that.
Generally, you might think that Social Security, extending Social Security to age 70 and starting at 70 is the cheapest income annuity that's out there in the market because it's based upon these 1983 tables.
Right.
Play devil's advocate. Is there any reason why Social Security should not be extended to 70? Assuming that we don't know exactly what someone's life expectancy is, et cetera. We're talking about average numbers. Is there any reason why Social Security is not the best income annuity?
No. Well, yeah, I've written, other people have written too. Social Security is basically, if you view delaying Social Security from 62 to 70, so your missed 62-year-old benefits for 8 years as a premium to buy an annuity, which is the 76% higher Social Security benefit at age 70. The implied payout rate from that is much more attractive than any commercially available annuity. And this is an inflation-protected annuity, which there are not many companies offering in the private markets. So you've got the longevity protection and so forth, inflation protection.
But your break even is like 17 or 20 years, isn't it?
No, not that far. Your break-even is generally going to be around, well, yeah, from age 62. You've got to make it to about age 80, depending on your discount rate, somewhere between 80 and 84. But that's where, kind of the same point I was making about this slide. You got to make your retirement plan under the assumption you're going to live, not that you're going to die. So I think a break-even age of around 82, it's reasonable. Although if, in terms of not delaying Social Security, if you have some sort of terminal condition, and if both spouses, because for a couple, the higher benefit is really going to be around for as long as at least one member of that couple is alive. Thus, if both spouses were around until the first person dies, but the larger benefit's around until the last person dies. And so the idea that, at least for a couple, the higher earner not waiting until 70, I mean, it's much more than a 50% chance that at least one member of that couple is going to live beyond the break-even age. It's not like it's a low probability event. It's actually, your best guess is that you're going to live, at least one of the two people is going to live beyond 82. That's below, life expectancy is around 90 for at least one member of a 65-year-old couple.
Did the mortality tables come out? The new life expectancy is 82 and 86 or something?
That's for a single male and a single female. Yeah.
It goes up.
For a couple, one person living, a male and a female, the couple, at least one person, not that they both live, but at least one of them stays alive, the life expectancy is around 90. Because you don't know which person, it's just one of them is going to live to at least 90. So you can work through the math for that. But yeah, I mean, that's for a single male, the break-even, so that's life expectancy at 82. Well, if that's also the break-even age for Social Security delay to pay off, basically 50% chance that you're going to benefit from delaying Social Security. And if you do die earlier, though, it's this kind of situation. Retirement was not as expensive. It's sad that you missed out on some Social Security benefits that you could have had. But I'm more worried about that second half, where retirement becomes more expensive. And that's where eking out every bit of income that you can is really important. The other argument I see about reasons to not delay Social Security, I see this argument all the time that take your Social Security at 62 and put it in the stock market, and you'll earn more than you get by delaying Social Security. The probability of that happening, well, for somebody who lives to at least life expectancy, because the return you get from Social Security, it's an internal rate of return that depends on how long you live. But once you start getting beyond life expectancy, you're talking about real compounded returns of 5 or 6 or 7% from delaying Social Security. The probability of getting that from the stock market over a 10 or 15-year period, I don't know if that's over 50% or not, but it's not at all any kind of, like, the odds are not in your favor of a retiree being able to have their stock portfolio outpace the implied yield of delaying Social Security.
That strategy you just mentioned, wouldn't it be similar to taking that check mark curve and just flipping on its x-axis so that you now have more money at the beginning and then less money or less chance of having liquidity at the end?
For the
As you just mentioned, if you were to invest if you were to take your Social Security early, you're now increasing your current liquid assets by getting more money. But at some point in the future, you're going to wind up with a lower probability of having liquid assets.
Yeah, well, you would have you're permanently locking in a lower Social Security benefit. And so once you get past that break-even age, you would have been better off having a higher Social Security benefit. So we're basically getting close to the end. Let me check on how we're doing on time. Oh, we're way past time too. Okay, just the last couple of slides were different ways to manage sequence risk. I think I mostly talked about this. So for an investment manager, for a retired client, asset allocation should not just be a risk tolerance questionnaire. That's point 1 on this slide. What's the client's risk aversion? What's their sensitivity to short-term fluctuations? Also consider these other factors as well. What kind of distribution rate are they needing? How much flexibility do they have with their spending? How worried are they about outliving their assets? How sensitive is their spending to inflation? What's available outside of their portfolio to cover their liabilities, so pensions and Social Security and things? What kind of buffer assets do they have, especially like home equity and so forth? And then how are they covering their contingencies? Use all that to figure out asset allocation. And here's just a list of kind of putting this all together of ways to fight retirement risk. So I'm happy to stick around for a little while longer, but I'm sorry, we're over time, so if you need to leave, I understand it. But if there's any questions, I'm happy to stick around. Thank you.